All right, Rebels. Today's report, this briefing is from the Epoch Times, 9th of March, and it is by Tom Ozimek, O-Z-I-M-E-K. So once again, Epoch Times. So stocks plunge while bonds hit new lows as oil, price war, and virus combine into perfect storm. Stocks plummeted and investors rushed into safe haven bonds Monday as the worst one-day crash in crude oil prices in 30 years combined with ongoing coronavirus fears into a perfect storm that sparked a sell-off dramatic enough to trigger a temporary curb on trading at the New York Stock Exchange. I'm going to scroll down here. The dramatic flight from equities followed the collapse of a supply constraint alliance between OPEC and Russia, with Saudi Arabia launching a price war by announcing Sunday it would cut crude prices and increase production. So a little commentary, remember the U.S. produces more oil than either one of these countries, but now they're squabbling amongst themselves. They can't come to their limitation agreement, so they're going to start, at least Saudi Arabia is going to start pumping as much as they can and reducing their price. I think it says 20% later on in the article. So this may affect the U.S. and it may not, but the stock prices is you'll see they're volatile, and it says because of the priming of the pump with coronavirus fears. A lot of hype is going on there, and as you know, stock market is very psychological, emotion driven. They like to think it's scientific. All three, continuing with the article, all three major Wall Street indexes, Dow Jones, NASDAQ, and S&P 500, closed over 7% down in one of the worst days on Wall Street since the financial crisis, and that's referring to 2008. The blue chip Dow lost over 2,000 points in what was its biggest single-day point drop in history. And this is a chart. Let's see, let me read you. The table showing the main three Wall Street stock indexes: S&P 500, SPX, Dow Jones, Industrial Average, DJI, NASDAQ Corporation, NASDAQ Composite, along with the VIX volatility rating or fear gauge. This is the VIX right here that they've got highlighted at 54.5. You'll see what that's talking about. I've never seen this. After scaling record highs as recently as 3 weeks ago, the S&P 500 is now only about 2.5% away from moving into bear market territory in one of the most dramatic turnarounds in living memory. The bear market is defined as 20% down from a recent market high. Well, in the short term, I think we should be worried, said Peter Cardillo, chief market economist at Spartan Capital Securities, in remarks to Reuters. But I also believe that even if we go into bear market territory, I don't think it'll be long lasting. Why? Why would he think that? He doesn't say why, but the American economy is very strong right now. And what the market does doesn't really affect the economy. It affects your portfolio, your 401k, all these type things, but it doesn't change the economy. The benchmark 10-year U.S. Treasury note, whose yield falls as its price rises when refuge-seeking investors pile in, dipped in overnight trading to an intraday record of 0.339%, according to the Wall Street Journal, citing TradeWeb figures. The 10-year closed on Friday at 0.709%. I've never seen this, and I've been doing this for 30 years, said Scott Thiel, chief fixed income strategist at BlackRock, in comments to the Wall Street Journal. It's about risk management, he added, explaining that bond yields were being driven lower by investor fear of what may lie ahead for the economy and markets, which is foolish. We have a strong economy. And the way bonds work is very simple. Is if you got a bond that's worth $10,000, you buy it for $9,000, your yield is more than if you bought it for $9,500. That's the short and simple explanation of how bonds work. Okay, so here's a nice chart. 10-year U.S. Treasury notes. It's a new, intraday low. But this is the title of the next section is Volatility Reigns. And if you can follow the cursor here, you see all these ups and downs, ups and downs, ups and downs. That's all volatility refers to, is the change in price over time. Oops. So volatility reigns. Wild swings in markets were evident in volatility measures in both stocks and oil on Monday, because the announcement from Saudi Arabia was announced on Sunday. Wall Street Fear Gauge, or the VIX Volatility Index, which is a measure of implied market swings, shot up to nearly 60. We saw it was at 54, a level not seen since the 2008 financial crisis. A reading above 31 is considered to be reflective of extreme levels of investor fear and uncertainty. When you look at volatility regimes, once you get above 31 on the VIX, you have an uninvestable environment. There is no valuation as a catalyst, explained Hedgeye CEO Keith McCullough on the February 28th episode of The Macro Show. If my market signal doesn't give up greater than 31 on the VIX, I'm not buying a damn thing on this dip, because it's not a dip, McCullough added. And remember, that is his opinion. So remember, the previous guy's opinion was that it would not last long. It's all based on opinion, guys. So the oil price volatility index, or OVX, hit an all-time record high Monday. And there's volatility. Perfect storm. Crude oil prices plunged by around 20% Monday. There you go. Sending oil majors Chevron Corp and ExxonMobil Corp down more than 9%. State oil giant Saudi Aramco said in a statement March 7th that it was cutting its official selling price for April for all its crude grades to all destinations, amounting to unprecedented discounts of nearly 20% in key markets. Nearly 20%, that's a big drop. The move has been widely reported as an overt bid to wrest market share away from Moscow after talks between Russia and the Organization of the Petroleum Exporting Countries, OPEC, failed to agree on production cuts amid a coronavirus-driven collapse in oil demand. Less travel, less demand. Very simple. Look, you've got one of the most powerful commodities in the hands of two of the largest superpowers in the world, and they are not agreeing on it, said Peter Tushman, NYSE trader, in comments to Reuters. And you throw that on top of a market that's full of anxiety about the potential economic global slowdown due to the virus, which I don't even think we've seen yet, you end up with a perfect storm. That's what we have in there today, referring to the exchange. While cheaper oil will translate into more affordable energy for consumers and businesses, it hurts producing countries and companies. That's the end of the story. It says Reuters contributed to this report, but they also quoted Wall Street Journal. So Wall Street Journal and Reuters contributed. So a brief commentary, guys. What happens in the market does not affect Main Street very much. As pointed out in this article several times, talks about anxieties, fears, uncertainty. Stock markets are driven by emotion. So don't get swept up in the emotion. When there's a big drop like this, it's always a buying opportunity if you've got extra income available. I don't, but be that as it may, I'd rather stock up on the big commodity in demand nowadays. You've seen riots and fights breaking out over toilet paper, not oil. So that's your briefing, rebels. Go out and speak freely.